Hey, this is Ryan Calley with AZ Health Insurance Brokers. The purpose of this short video is to discuss the 4 different ways that employers can roll out an employee benefits plan. So the first question is, do you fall in the 51 or 2 to 50 space? And what this is your number of eligible employees. So if you have 2 to 50 eligible full-time staff, you're gonna fall in a number here. If you have 51 or more, you're gonna fall into this pool here. So we'll start here. So in 2 to 50, there are really 3 ways you can roll out an employee benefits plan. There is a fully insured plan. So we'll start here. In this segment, fully insured is always community rated. And that just means your rates are based on age. Doesn't matter if your group is healthy or sick or really anything. The only thing that matters is where's the company domiciled, and then there will be respective rates based on your employee ages per plan. So someone who's 20 might pay a little bit less than someone who's 30, and etc. So the important piece over here is that your rates are only driven on age, not experience, not pre-existing conditions, literally just age. On the flip side, you have level funding, which in the 2 to 50 segment, you can explore as an alternative option to fully insured. So if let's say you're over here and you've got a lot of healthy employees, well, you actually might get an offer made to you in the level funding segment. And there are different ways, but carriers kind of peer into the health of your group based on, past utilization or based on a prescription drug tool that they have. But they'll look at your group and they say, okay, you're healthy, so we'll let you into our preferred risk pool. You'll get a discount on your insurance. You'll actually be able to get money back at the end of the year, contingent on a few pieces. There are actually a lot of other variables to this platform, but to keep it digestible, I think the main takeaways are that this is underwritten and you have the ability to get money back at the end of the year. And what I mean by underwritten is that if you experience a lot of claims, your rates are going to go up significantly in this. And similarly, if you run very well, you're going to get a good renewal. Whereas over here, it's only based on age. So a little bit different, but this is always an option. So if you go over here, you can always come back here as long as you fall in this 2 to 50 eligible segment. You can also look at a PEO. What a PEO does is they aggregate you with different groups, which on the surface level sounds great, and it actually might be. There are other value additions to the PEO, but typically the expenses of the admin fees outweigh the benefits of this platform. Definitely worth exploring as an option, but just typically that's what we see, especially if you have more than 20 employees. This becomes a relatively expensive proposition when you compare it to the alternatives, but each group's different, so definitely worth at least taking a look at a PEO. Okay, so that's the 2 to 50 segment. Now we'll get into the larger employer segment, or the applicable large employer, which just means you have more than 51 full-time eligible employees. So you'll see fully insured is repeated, level funding is repeated. Now we have this new topic, partial self-funding. We'll start here on the fully insured side. So what was community rated over here, which again just means that the rates are based on age, becomes underwritten when you have more than 51 employees. So there are different tools that carriers look to explore the health and utilization of your group. But the important piece here is that if you have more than 51 employees, you go fully insured, that plan is underwritten, and it will be based on how you use the plan. Similarly, level funding is there's the same feel, where there are different benefits to being in this platform over here, but it is underwritten. You have the ability to get money back at the end of the year. This is actually a partially self-funded product, but the carrier is taking on the risk. So from the employer's perspective, your max risk is the premium alone. And that's, again, a really important takeaway is that you have no exposure beyond the premium. But pretty similar to fully insured on a surface level. On the back end, there's a lot of different moving pieces here. But from the employer's perspective, really the big differences are you might get better rates here, and you actually might get some money back at the end of the year if you run well. So, but otherwise, these have a similar feel, again, from the employer's perspective in the 51 plus segment. The last topic is the partial self-funding. So at a certain point, if you're running really well, and if you have enough scale, so for example, 300 employees, does it make sense to pay an insurance company $50,000 a month for your insurance? Or does it make more sense for you to kind of internalize that and become your own insurance company? And that's more or less what partial self-funding is you isolate yourself. You actually, as the employer, pay out claims to a certain threshold, and it allows you to kind of disassociate yourself with the other risk associated underneath these carriers. So for example, an insurance carrier might have hundreds of thousands of clients. Do you want to be lumped in with those other clients, or do you want to be on an island by yourself. For some groups that makes a lot of sense, for some groups that doesn't. If you have a young, healthy demographic, this can actually be a great way to save a lot of money. There are more administrative costs and it's more cumbersome on administrating it. But overall, these strategies make sense individually for certain groups. There's no, hey, you should be here based on your size, or this makes sense at 250 employees. It doesn't work that way. You might have 1,000 employees and this might not make sense, versus you might have 100 and this might be a viable option. And the same, it's true to all of these. So I hope that was helpful. That is the 4 ways you can fund insurance.